comes.
Okay. Now the Mr. Zhang just linked to my next question to the Michael and Bill, and we'd like to discuss about what strategy, what area, what underlying asset are we looking for the next 1 or 2 years under this environment? Where is the risk? And if you guys pick up 1 or 2 opportunistic strategy, which makes sense for the next 1 or 2 year, what would it be? For example, if COBA or NTS try to increase their portion of the global hedge fund, what kind of strategy can you suggest? You can suggest your own strategy.
Sure, I'll jump in and offer a few
All right,
thoughts.
go ahead.
So I guess I'll start with my market views, but I wanna put a disclaimer on that. So at Balyasny, you know, we're a multi-strategy firm, and the teams do not have to adhere to any one person's top-down market views. That said, a lot of the teams do have interest in hearing my views or Dimitri's views or some other people's views. So internally, the teams are often asking me, what do I think and what do I see as the opportunities? So my views are as follows. I do believe the U.S. economy troughed in April, and it's now recovering. You know, could a second wave of cases occur, or is it occurring now? Perhaps. That may change the slope of the recovery, but in my view, it does not change the direction, i.e. I think the recovery will still come. 2020 is obviously not a normal year in a host of different dimensions, but one such dimension is how you value companies. You cannot use the 2020 numbers to value companies. So I'm pushing teams to use 2021, and in some cases even 2022 for valuation purposes. The way I think about valuation for the broader U.S. market is I like to think about what are the earnings for the S&P 500 index. And for some perspective there, for this year, before COVID, people thought the S&P 500 would earn approximately $175. Now, during the depths of the COVID crisis, that number came down sharply. In fact, some of the leading sell-side strategists took it down as low as $100 to $110. But very quickly, the market started to dismiss the 2020 numbers and instead use a normalized 2021 number. And in April, that normalized 2021 number was approximately $150 in S&P 500 earnings. Now, what's interesting is obviously we're getting earnings reports here right now in the U.S. market. The earnings season is coming at us daily here. And the earnings numbers that are coming through are actually pretty good. Now, when I say good, I mean good versus consensus. Yeah, good versus consensus. They're not good on an absolute basis, but they are good versus consensus or versus the expectations. So what I think will come out of this earnings season is that 150 to 160 normalized S&P earnings estimate for 2021 will go up. I think it'll probably go up to around 170 in earnings for next year. And if you use a multiple range of approximately 16 times to 20 times on that 170 figure, that gives you an implied price range for the S&P 500 of approximately 2,750 to 3,400. So today we're at 3,250. You know, there is some upside, but it's not super compelling. But I do think you'll continue to see this sector rotation go on within the market. And you know, people like to talk about things these days in terms of factors. You know, is it value or is it growth? I'm old enough to have been an investor before factors were invented. I don't think this is about value or growth. Instead, I think this is about whether or not a company has either operating leverage or financial leverage. And if a company has either of those two forms of leverage, when the economy is contracting, that leverage becomes toxic and those stocks underperform. But if the economy is expanding, that leverage becomes beneficial to the bottom line and those stocks tend to outperform. So what you're seeing in the US is some of the quote value companies, whether they be industrials or beaten up consumer names, are starting to outperform, not because they're value, but because they have operating or financial leverage and thus benefit as the economy goes forward if it continues to expand. So I do think you'll continue to see more of this sector rotation. In terms of risks that I'm watching, a couple things. Obviously, the risk of a second wave of cases. My understanding is not just the US, obviously Hong Kong now is seeing some new cases. Germany is seeing some new cases. Spain is seeing some new cases. So we need to watch that closely. However, I think that's also partially offset by some medical developments that we believe are on the way. Both Regeneron and Lilly, two large pharma companies, are currently developing antibody treatments for COVID. It's likely that each will have data on their antibody treatments probably in the next week or two. The antibody treatment is potentially a game changer. So an antibody treatment could be used to treat severely ill patients. It would help them recover, but it could also be used as a preventive for people who have not been exposed but are in a high-risk occupation, such as a nurse or a doctor. So it really could have the potential to be a game changer. So that would be a risk to the upside. And then the obvious risk coming up in the US is the election on November 3rd. The election, everybody is obviously watching, whether Trump or Biden. But I think it's, more important to watch the US Senate. And if that flips to the Democrats, if it does, and the Democrats win the presidency and the House, they would then have control of all three branches, and you could see major changes of legislation and regulation impacting financials, healthcare, defense, and energy. So with all that said, I think, my market view here is a little bit neutral, but I think there are still lots of bottoms-up opportunities.
Very good. Very good. Sounds good.
So maybe I'll give my own take on our part of the market. I think Bill's done a great job talking about the equity market, so I'll stay away from that. Fixed income markets, in many respects, central banks have made the credit investors' jobs somewhat easy. Like I had a friend of mine who's a competitor and a friend once joke around that there was only one sure money-losing investment in the world, and that's cash, because over time it degrades in quality. And the easiest alternative is to invest in things that generate income for purposes of staying ahead of inflation and so forth. And when central banks are pushing rates down to 0 or below 0, the relative value of income generating products becomes more obvious. And that's certainly been the case with our underlying clientele, who are now, once again, seeking for yield and fixed income alternatives in different contexts. And so I think, the demand for our skill set has certainly gone up almost inversely with the movement in rates by central bankers. So all that said, if the question is, where do we see opportunity and how do we view the market environment in our particular niche in the world? With respect to the large cap part of the world, those are not our focus. Our focus are more in the mid cap parts of the world that have been sort of part of a cycle of increasing leverage, whether through leveraged buyouts or otherwise through cheap costs of funds that have pushed companies to add leverage to their balance sheets. And that's creating a headwind which even some economic recovery, in our view, will not be sufficient to overcome. And so in our view and in our part of the world, we continue to think that there are going to be interesting opportunities to generate what for us are above historic rates of yield. Just to give you a data point right now, when you look at our flagship fund, and this is a very diversified fund that has over 120 different positions, and you look at the performing part of our portfolio, today that is generating a yield to its benchmark of roughly about 11%. So like even in a world of declining interest rates, our part of the market has lagged, and continues to offer opportunities to invest in good companies with bad balance sheets that are probably in need of restructuring, and offer to our clients, most of whom are pension funds, and as an alternative are looking at investment grade fixed income portfolios that yield 0 or near 0, even with somewhat of an increase in volatility and risk factor in terms of the types of investments we make, look through a cycle at an asset class that would be very difficult to underperform. And in fact, is probably looking at an era of above market returns over the next several years. And so that environment, you know, the complexity is higher, and the selection process is a bit more difficult for a lot of the reasons Bill mentioned. And it's important to pick out winners and losers, and it's important to pick out good businesses from bad, and you know, sort of distinguishing bad businesses from just bad balance sheets. And so that's made the credit underwriting process difficult, but the broader market backdrop for our business more attractive. So in that context, I think we'll be very active over the next several years. And we tend to be conscientious about making sure the amount of capital we have raised from clientele to deploy is consistent with what we think the opportunity set is. So we have been raising some capital to pursue the type of opportunities that we see. And so, you know, it's tough for me to predict what % of our portfolio will wind up going through restructurings and will end up being ownership positions and equity positions rather than today's fixed income positions. But in each of the investments we make, we're more than comfortable taking that path if necessary. We think of ourselves a bit as, you know, as I would say, like investors protecting justice, in the sense that today we also live in an opportunity where some of the owners of private businesses, like private equity funds, have become very, very aggressive in challenging creditors' rights and using coercive means to extract collateral that otherwise, you know, might rightly belong to the value of creditors, but through loose covenants and so forth, maybe there's some ambiguity in those rights. And so we apply our comfort in bankruptcy and legal processes really to defend those rights and to protect value. And so in that respect, this environment also, I think, highlights one of the things we most enjoy, which is, you know, defending our part of the market and maintaining and enhancing value where we can do that. You know, it's hard for me to perceive an environment where rates are going up anytime in the near future. And so I believe that fixed income alternatives will continue to be the better relative value for institutional investors versus investment grade. And in our world, we migrate both between public credit and private credit. So just touching on that for a moment, in 2019, one trend that we saw were larger private credit managers displacing public market alternatives. So these were big private pools of capital underwriting loans and bond deals, rather than investment banks who would then distribute those deals through the capital markets. Walking into a crisis like the one that we've experienced over the last 6 months, some of that displacement has slowed, but I continue to view that to be a trend. And so we've also positioned ourselves to be able to take advantage of private credit opportunities with the pools of capital that we now manage. And I think that trend will continue. My view is that private credit managers will continue to be more nimble, more flexible, more thoughtful, and faster in execution than the typical investment banking or capital markets alternative available to buyers of businesses or companies who need refinancings. And we'll be able to earn attractive returns on capital, maybe even better than public market investors, through their ability to take longer term risks with less liquid strategies. So there's a couple trends we're looking to capture in the next several years. Mostly, you know, if you're in our business, this is the type of cycle you look forward to. I say that, you know, a little cynically, because for many people in the world, certainly in the United States, there's a fair amount of economic pain. So it brings me no great pleasure to find economic advantage in this type of cycle from a personal perspective, but from a business perspective, it's a very good environment.
Thank you, Michael. So Michael said private credit market, private credit strategy will continue to get some benefits under this market environment in the next 1 or 2 years. Is that correct?
I happen to believe that, and I think that that's a trend that will continue, that has started going back several years and will continue several years into the future.
I see.
And
I
at
see.
least in more complex credits, I believe
see.
private credit providers will become the majority of the market.
I see.
Typical.
I think now we have Mr. Kim Jun-gun from NPS, National Pension Service. Yeah, he has a question.
If I'm allowed to ask, I have 2 questions. So one is actually to, Michael. So clearly, we can see more opportunities in credit space, as you mentioned. The 100 billion, bankruptcy, amount is, definitely, it's larger than we have seen in the previous years. But problem is, still there are, there is much liquidity, chasing the same opportunities. So we saw a little bit ridiculous, situation like, a company in bankruptcy, Hertz, issued the common stock in the stock market. So you believe, this is a good entry point, for investor to invest in more, hard catalyst, distress, type, strategy. And secondly, I think this question is more to the Bill. So we could see, a strong alpha generation in the long side of portfolio in equity long short fund, but it is quite concentrated to certain sector like technology or more growthy stock. So naturally there are more worries from investor that about the potential risk in crowded investment from a hedge fund manager to certain sectors or certain stocks which lies is rising quite like including Tesla's that most retail and low investors are actively chasing. So what is your thought on this kind of potential crowdness issue?
Good, thank you, Mr. Kim. Yeah, Mr. Kim asked both Michael and Bill want each other. So who's going to be answer first? Michael, can you answer? Yep.
Yeah, sure. I'll go first. So the question, just to restate the question was, do we think this is an attractive entry point for more event-driven sort of distressed managers, I think. And, I think the question was, yes, there's a lot of defaults and bankruptcies, but equally there's a lot of capital formation. So first off, you're right. There has been a fair amount of capital formation around distressed opportunities. And second, the bankruptcies that have occurred so far have been in, relatively narrow sectors. Like there's been a fair amount of retail bankruptcy. Mention a name like Hertz, which is, I think of those as companies directly impacted by the virus. I think when we think about the opportunity set that I've been talking about, we think about what we regard as sort of the second derivative impacts of the virus. That will be companies that are already over leveraged will see some contraction, maybe even permanent contraction in their business, and have balance sheets that are just sort of over leveraged. And so we view a second wave of distress to come as a longer term opportunity set. The one that we mentioned in March, it's fair to point out bond prices dropped dramatically, in some cases 20, 30%, and created attractive entry points. But a month later, a lot of that capital appreciation opportunity had already occurred. But going forward, most companies that we follow and track and have in our sort of list of companies that we think are likely to be future opportunities had enough liquidity to survive for a month, 2 months, 3 months. Maybe they've been able to tap all of their available revolving credit facilities. And so they may have liquidity for 6 months, 9 months, but at some point they will both run out of their current source of liquidity and the flexibility they have in their capital structures to raise more capital. And then they're gonna need to go through a process. And so I think it's just a little early to see the broader opportunity set that we envision coming. Second, just to distinguish ourselves from the market, many of our competitors manage pools of capital substantially larger than BeachPoint and would tend to be driven to the largest capital distressed opportunities like in the US PG&E, and you mentioned a name like Hertz. At our size, we're perfectly comfortable investing in companies that are, $500 million or $1 billion of enterprise value and that we would regard in middle market. And those are ones that are typically not followed by firms many times our size. And so we tend to find a lot more opportunity. You mentioned the third thing, which I'll touch on briefly, which is just liquidity. And liquidity in the sub-investment grade fixed income markets can be, I guess what I'd say is, it doesn't really lend itself to tourists. What I mean by that is, we often see multi-strat funds who sort of delve into the distressed markets periodically, and may find a month or 2 or 3 where they, will make an effort to buy bonds and get involved in loan situations and so forth. But we take a much longer view. I mean, we're trading with the same counterparties all the time. And we're happy to wait for the one day where 20 million bonds come for sale. And, for a company that may have $500 million in debt, those blocks of opportunity, are really only available to people who are constantly looking in that market and involved and discussing with counterparties and looking for that flow. And so for that reason, I think the opportunities are much more available for sort of the permanent players in the market than they are for sort of periodically entering and exiting. And so in the names we're involved in, we may pick a company and a security and a price level, and it may take us 2-3 months before we really find an opportunity to deploy capital, but we'll stay disciplined about price, and we're happy to wait that period of time. So that's sort of how I think the different questions you asked. Hopefully that's responsive.
Mr. Kim, is that good for you?
Good. Yep.
Thank you.
All right, Bill, how can you manage that concentration risk of your equity market, equity portfolio?
Yes, thank you, Mr. Kim, for your questions. So our performance year to date, we look at it in numerous different ways. One way that we look at it is across the 3 main regions that we invest in, those being the US, Europe, and Asia. And performance in all 3 regions year to date has been positive. Asia was clearly the toughest region in Q1, but by the end of Q2, the Asian books were performing better, and many had turned the corner and were now positive. And when we end July in 2 days, that trend will continue. Asia's been a good region for us. So we look at it that way, our regional exposures and whether or not, a region is underperforming versus others. And then within the US, we look at the sector exposures. So we look at the 11 S&P sectors. We don't necessarily have an adherence to 100% replication of the S&P weightings in those sectors, but we'll always be close to the S&P weightings within those sectors. In other words, we're not going to allow the portfolio on an aggregate basis to be dominated by tech or consumer or healthcare. Interestingly, all 11 sectors are up year to date as well. And I think there's a couple of reasons for this. So first off, volatility is clearly higher in this environment than it was in 2019 or 2018. Volatility is a good thing for our model as long as correlations don't go to 1. So far volatility has increased, but the correlations have not increased. So that's been helpful for us, number one. And number two, within each sector, this concept of how are spending patterns changing, whether it's at the enterprise level or the consumer level, it applies within each sector as well. And, you know, take energy, for example, okay? Energy would not be seen as a beneficiary of COVID. It might even be seen as a negatively impacted sector. But even within the sector, there are some companies that, you know, because of changes in CapEx planning or because of changes in miles driven in the US, their fortunes are increasing more rapidly or decreasing more rapidly than the average company in that vertical, depending on their business mix. And our teams have done a good job of capitalizing on that. Financials would be another example. Financials are not a sector that would be perceived as a beneficiary of coronavirus. And yet within financials, you know, we can look at what's the credit exposure, you know, who's got the strongest balance sheet, who's got the best reserves, and also what's the interest rate sensitivity of the various financial institutions. Because as Michael said, which I agree with, I think low rates are here for the foreseeable future. And some banks will fare better in a low rates environment than others. So again, this is how our teams look at it, and this is how they are able to generate alpha. And because the fundamentals have been changing rapidly, I do think that's been to our advantage because we're able to execute the analysis, and with our multi-strat platform, we allocate capital to the teams. The typical team size is running a portfolio of about 800 million, so it's a relatively small, nimble portfolio. And as they see these changing variables and they see the changing fundamentals, they're able to implement it in their portfolio relatively quickly versus somebody running a $10 billion single manager type fund. Now, the second question that you asked about, I believe, was about crowding and the potential for an unwind type period, similar to what we saw most recently in Q4 of 2018. And before that, we saw one in Q1 of 2016. I'm personally hoping we never see another one in my lifetime, but I don't think that's realistic. I fully believe we will see another one. I think actually potentially you could see one this fall. We can talk about that if you'd like, why I think that. But what we have done at Balyasny in terms of crowding and unwind risk, we had a new chief risk officer join us, Alex Laurier, in the middle part of 2018. Alex, I think, has done really strong work in this area. We've developed some proprietary metrics that we feel give us sort of early warning signals of when a crowding unwind could occur. So that's been helpful. Number two, we've looked at what each team covers in terms of their actual stock or company coverage. And if we see that we have 7 teams covering one name, just to give you an example, we'll encourage 2 or 3 of those teams to not cover that name and to go pick up a name in their vertical that is less well covered. So by having the coverage spread out more across the teams and not having every team cover the same 10 names in a sector, that too helps in these crowding periods, because in a crowding period, what becomes toxic is crowding. And if you're in names that are less well covered, almost by definition, they're going to be less crowded as well. So I'm not complacent. I do fear the next crowding unwind, but I can assure you we are better prepared for it than we were in the prior episodes.
Thank you. Mr. Kim, is that good? Mr. Kim, by the way, could you explain the NPS current situation about the hedge fund allocation? What is your story? What's going on in NPS, Global Hedge Fund? We know you have had some funds of funds investment, and now you are preparing. Maybe did you start single fund allocation already, or what kind of the strategies are you looking for, and in terms of the size and scope? Could you briefly explain us since you are here?
I think you're on mute.
Mr. Kim? We cannot hear you. Mr. Kim, can you?
He's muted.
Oh, yeah.
Yeah,
you can hear
go ahead.
Me? Yeah.
Yes.
Okay, so actually, we started 2016, and after John, clearly, understand we are very, slow, very conservative.
I'm
and
sorry,
careful
Mr. Kim.
investor.
Mr. Kim,
Yep.
your voice is very low. Can you
Okay. Hello.
up your voice a little?
Yep. Hello. Can you hear me?
Yeah, we can hear you. We can hear you, but a little.
Okay.
The sounds you. Yeah. Go ahead.
Okay. Okay. So I will speak a little bit, loudly. So as you know, so we spent almost 4 years, right, working with two gatekeeper, fund houses, and now actually we started late 2019 our launched our single hedge fund program. So the names of the manager who initially picked up are already disclosed in our website. So I think we have a long way to go. So the good thing we have now from having our single hedge fund program is that we can have more control, or more decision making power in controlling our portfolio. So we don't believe the market opportunity which has been dramatically increased since COVID crisis will end without within several months. So we believe there'll be still plentiful opportunity in hedge fund spaces for the upcoming years. We are working on some plan how we will increase our allocation to overall hedge fund program and to specific strategy area. So we are very much constructive in hedge fund investment. But problem is that now the some asset the valuation performance is become very high, like an equity valuation, as you know, is going high and higher each day.
Hello.
Fixed income side, we have very low lower expectation from fixed income side. So we are very big difference in the two asset classes. So there are many diverse opinion how we will place our expectation from hedge fund investment between the two extreme big asset class performance. So maybe we can chase equity like return, or we can comparably chase alpha with the stability of a fixed income like volatility in hedge fund, our hedge fund program.
I see. Do you have any private credit types of strategy, private debt, private credit strategy on your table as a single manager?
Yeah, but private credit is the area we launched it separate of program in last year.
You mean separate to the hedge fund?
Right. Yeah, we can invest through some hedge fund vehicle, but we have separate program for private credit. So I think that will be also the area of focus in the future from MPS perspective.
I see. What is your current size AUM of funds of funds and single funds you're allocating?
So our size is small, the 1.7 billion in total, and have still a larger portion in fund of fund portfolio. But we have internally planned to increase both the size and the proportion of single hedge fund program together.
I see. Any questions from Bill or Michael? comments? Good. Brant, any questions?
I just have a broader question, I guess, which is, and maybe I've just lived through too many economic cycles, but and maybe also I have a U.S. perspective, because when you walk the streets of a place like New York City, it's just striking how it's closed for business, by and large, right? And we have, on the one hand, I guess when you ask people how the market can be so buoyant, the answer you usually get is because the central banks rushed in and made it very clear that they would provide support. We're seeing in the U.S. Unemployment checks that are starting to run out. The amount of money that was pumped into the economy, the trillions, it's not so clear that the Congress is going to approve it a second time. And I just wonder, and a coronavirus that hasn't gotten better situation. So I just keep wondering, where is all this pain going to reflect itself, right? I mean, I'm delighted that the public markets seem to feel like the future is so rosy, but I guess the disconnect between the underlying fundamentals in the economy and the way the public markets are looking at things, I kind of felt like the two participants we have today, which is why I recommended them to you. You've got a hedge fund that certainly should be able to capitalize on volatility, and you've got one of the experts in private credit who knows how to cover distress from every possible direction. So I guess for me, before this call ends, I would love to hear a little bit of that discussion. I hate to sound so dark.
No, Brent, I think it's a great question. I myself have been wondering, gee, why is the S&P at 3250 and why are so many stocks at all-time highs? I think there's two elements at work here, and I'm not sure they'll persist forever, but here are the two elements. So on the one level, when you look at the S&P 500, you are looking at America's biggest and best companies. These companies have access to capital, and I think by and large, most of them, if not nearly all of them, will survive this crisis. The companies that won't survive are your local dry cleaners or the restaurant that's owned by a family in Queens, things like that. Those businesses are clearly hurting, but they are not represented in the U.S. stock market. So I think that is part of this. The second part is, and this one's a little worrisome to me, but the second part is I think the emergence of the individual investor in the U.S. during this crisis is really quite a story. And I've talked to some of the people at Goldman Sachs and Bank of America. They now estimate that 25% of the volume in the U.S. stock market are individual investors. And these are, mom and pop or, family type situations. They're investing, a few $100 to a few $1,000s. But the reason why they're suddenly fascinated by the stock market is, I think, twofold. Number one, you can now trade stocks in the U.S. if you're a small investor for no commission. Fidelity and E-Trade and the rest have zero commission charge. So it's, quote, free to trade. And in addition to that, in a work from home environment, these people have more time on their hands, and some of the activities that they used to do, such as watch live sports and perhaps gamble on those live sports, they now are instead trading stocks. So I think that's very frightening, but it is real, and I think that's part of the reason why the market is where it is at. And it's why a name like Tesla or, a name like today, Eastman Kodak. Well, how could Eastman Kodak go up 40 points in a day? It's insane. But it's not people in this panel who are buying that. It is people who are at home day trading.
And you've also got a risk-free rate that's virtually zero, right? So there's no, traditional fixed income is not going to do anything for you. Or to Michael's point, it might even be negative.
Brent, it's the same situation here in Korea. Kospi index recovered already the last year's the historic high. And everyone tried to buy Kospi stocks at home. And they are enjoying volatility and liquidity in Korean market as well.
Is there a judgment day? I mean, does this? I mean, I know that perhaps this is where it is right now, but I'm just curious. The consumer. I thought the consumer was a big part of the global economy. I guess not.
Anyway.
Well, I think this is a risk. I think this is a risk for the market.
This is a risk.
clearly a risk. I mean, you know, retail investors will play the game as long as they're making money. But if they suddenly start to lose money, they're all going to wish to exit. And, you know, that's what happened with Bitcoin. And, you know, there is some potential for that happening in the stock market as well.